Hi, everybody. Welcome to the 7 and 7 show with Zach Ellison. This is season 2, and I'm here today with Adrian Mendoza, the managing general partner and founder of Mendoza Ventures in Boston. Adrian, thanks for joining.
Hey, Zach, thanks for having me, man. So that everybody knows how this hour is going to go down. This is an episode of Talking Shop and Talking Shit. And so we're going to do a little bit of both here, but also to level the playing field. Zach, we know him in the industry as the captain. So we'll define Zach as the captain for this episode.
All right, I like it. So tell everybody about yourself and how you got here.
Yeah, so I'm GP at Mendoza Ventures. We started about 7 years ago. My partner and I were both tech founders. Started our first company in 2008 during the GFC, had an acquisition event in 2015, and then we had raised VC money on ourselves. And we said, hey, I think we can do this better than most of the investors we knew. And we were right. So we kicked off Mendoza Ventures Fund 1 in 2016. 3 years later, we 10x the capital, had a successful exit from two diverse founders. Our first investment in that fund is a 20 to 25x because of diverse founders. And so we went out to market with an early stage fund in about maybe 2019, run by two operators, focused on investing in diverse teams, and have done really well. That fund 2 is now marked up by about 1.4x. And we went out to market with a fund 3. That's a $100 million fund. It's anchored by some of the top banks in the country, including Bank of America, including a few other banks that we've heard of. And the goal is to really treat venture capital not like the power law method, but more like a lower middle market PE shop. Very hands-on, very engaged GPs, helping from everything from go-to-market strategy to revenue ops to helping build a team out, building funding syndicates. And we now invest in companies that are $1 million to $3 million in revenue, really predominantly focused in the core strengths that we know: Fintech, AI, and cybersecurity, and headquartered in Boston, satellite office in the Bay Area.
Well, as you know, I'm from Boston originally. So we talked about that,
good kid from Brookline.
Yeah, good kid from Brookline, Mass. One of the things that you didn't mention that I think is really relevant is your fund is the first Latinx owned VC fund on the East Coast, if I'm not mistaken.
Absolutely right. We're really involved with a lot of the Latino GPs and everything from helping them scale to helping them grow. And it really started about when 7 years ago, there was very few Black and brown managers. And it was a lot of the PE GPs that started looking at us and said, Adrian, you're the first GP that is Latino and women owned on the East Coast. And we're like, no, we're not. And we started digging into it and we realized we were right. And now we have 2 more small funds in the New York area. But for us, we started Mendoza Ventures before there were emerging manager programs, before there were, any conversations about what is a diverse emerging manager, Black, pre-George Floyd type of, GPs. And we have really been focused on growing our fund, with ourselves, with great LPs that we know, but also investing in spaces that we know ourselves. We focus on diverse, teams because, these are fantastic valuations. These are unique individuals that are not, what I say, the white guy from Stanford, but are coming from across the US that are going to have more conservative valuations, that are bootstrapping their businesses and really need venture capital is for what it's worth. It's innovation capital. And that's for us what makes us really interesting and why Zach and I hit it off, because we saw the power of what this catalytic capital can do from both, the venture debt side, from both venture capital. And we really looked at Zach and I, we're like, all right, I live in Brookline. He's from Brookline. We shot the shit because of that. And we ended up realizing we can do more partnering together as venture and venture debt, doing things together. And that's really where our friendship has lied from. And, as both professional colleagues of what can we do together, but also how can you use both types of capital to lift up diverse founders and female founders to not sell more of their company, but also be strategic in how they do it.
Yeah, and I think you hit on some really interesting points. And one fact that a lot of people don't realize is that less than 2% of funding in the VC ecosystem goes to women and minority founders. I mean, it's shocking to think about 70% of the US population getting 2% of the funding. So the way I think about it, and we've talked about this a lot, is it's not only inequitable, but it's also economically inefficient, which means there's an opportunity to make outsized economic returns by creating access for people in those underserved groups. So I think it's just a huge opportunity now, both on the equity side and the debt side, because there's a lot of really smart founders that have built great businesses, but they just don't have as much access to capital. And so if you can be that capital provider, you can actually, get better founders and get deals done on very strong terms that are fair to both sides, but also economically very appealing for the GPs. And I think that's where the industry is going to head, and we're starting to see a lot more capital look into those spaces. But you're the first to launch a Latinx fund on the East Coast. We're the first venture debt fund that has a focus on funding diverse founders, including veterans. And I've talked about this in other podcasts where I think there's certain characteristics that founders need to have to be successful. And when you look at someone's footprint, and this is a term that Mike Ryan brought up in a previous podcast with me, and Mike ran equities at Goldman, was a partner there when they IPO'd, and eventually ran 18 billion for Harvard's endowment. So one of the smartest guys I've met in the markets. And he talks about this idea of a footprint. So not necessarily track record where you're looking at numbers, which is what a lot of investors anchor to, but what has this person and team done over their entire lifespan? What footprint have they left? What obstacles have they overcome, and what characteristics have they demonstrated that would make them more successful in the future? In other words, are they a good leader? Are they incredibly resilient and persistent? Do they have the vision? And if they've established that footprint of being able to achieve things in the past while overcoming adversity, that makes them much more likely to be successful in the future. So that's something that I think we both believe, that there's founders out there that have those characteristics, that the market is not being efficient in funding.
Yeah, can't agree more. It's what I call internally like the long tail of impact. Like, you give dollars to a founder, like, what do they do with them? Who do they hire? What communities can they affect? Because you make the business more valuable. You make the asset more valuable. If we come back to just asset allocation, what is the inherent value of the asset when so much things are intangible? And being able to add that qualitative aspect to it makes it even more valuable. I got interviewed by CNBC Asia just a few weeks ago, and they were talking to me about like the Instacart, and I said, look, the value of it is just, it's a brand that somebody knows. It's public sentiment is driving this. Something that's qualitative is driving a quantitative value. And that's what we see with these early stage founders, because for me, I don't invest in underrepresented founders. I invest in overlooked founders. It's amazing companies that someone is overlooking that are incredible. Like, I've got an Asian American founder off the West Coast, 2.5-3 million in revenue, has raised zero money. We were first money in, and we're buying at an incredible price. And really, our goal is to get him to the next, from 3 to 5 to 10 million in revenue. And my goal is that this company sells in the next 5 to 7 years. And it's an outcome to us. It's an outcome to LPs. And that's the thing about this business, is thinking creatively out of the box to just break out of the traditional pattern matching that's out there in this industry. I'm a big fan that, like, if you continue to invest in the power law method, these incredible founders, these incredible companies that no one's looking at, will never get invested. That's an untapped economic potential.
How would you define the power law method, and for those that don't know, and why it has weaknesses?
Yeah, because it's based on statistical significance. You will do 100 investments, 98% will fail, 2% will be success. And it's really interesting because now that's great when every company is a unicorn. That's great when everybody is raising money. But then you have an economy now where no one is raising money. No one is getting an out as an IPO. The same question was brought up on Instacart and they were like, yay, successful IPO. I'm like, dude, it IPO'd at a $9 billion valuation. Last round was at 39 billion. It lost 80% of its value. Why are you cheering? The last round investors just got crushed. They're lucky to have gotten their money out, if at that. And so the same is said about this overall industry. When you're basing it on 90% losses or 98% losses and 2% unicorns, you're losing so much money. But when not everyone's raising money, your losses are just going to continue to compound. And our view was completely different. It's why we look more like a lower middle market private equity shop, where we're only doing 12 companies, not the typical 80 to 100. And we're spending 2 to 3 months on due diligence. And we're looking at outcomes that aren't IPOs. We're looking at early acquisitions. And yes, once in a while, they will be a breakout star. But I'm looking at how do you create liquidity events in 5 to 7 years. And if you're doing that, you can't exist on just traditional sources of venture capital. You can't think, oh, a Sequoia or an Andreessen's going to come in. We're looking at everything from mid-market buyouts, lower middle market buyouts, leveraging credit, leveraging venture debt as alternate funding sources, because it's not going to be your traditional trajectory. And it's funny enough, I know an investor that's in one of our companies, and he would talk to me about traditional venture fundraising, and he would be like, no, there's venture, and then there's everything PE does. And he was just adamant against alternate sources of funding. He was only like a good company, he's only venture company. Well, one of his companies had a majority buyout, and then next thing you know, he had a liquidity event, still shares in the company, he's going to get 2 bites of the apple. And he came to me and goes, why didn't you tell me about this? And I'm like, I've been talking about this for years as alternate ways for funding and exits. And he's like, why isn't everyone doing this? Because everyone thinks that the power law method is you raise money, you keep on raising money, and then you find these unicorns that are then going to have an IPO. But when the IPO market is shot and valuations are being 20% of total, like, you've got to find other funding sources, you've got to find other exits. And that's what we built our entire view of our portfolio is, let's find these 5x exits, these 10x exits in 10 years. I get the same stats as a traditional value fund. Singles and doubles win the ball game. You don't have to hit a home run.
Couldn't have said it better. I agree. And that's really our philosophy around venture debt, in the sense that if we compound returns at 15% per year conservatively, that means every 5 years your money doubles.
Absolutely. And not only that, the time horizon for venture is traditionally 16 to 17 years. Like, I don't have that kind of time. If I can double my money in venture debt in 5 years and then do it again in 10, and then have an acquisition event where you now may have a warrant or you have some liquidity preference, it's a win-win for everybody. And that's really that, starting from the LP side, to start changing the perspective on how do you generate liquidity events, because they're not going to be from the market. If it takes 3 to 5 years from opening up, that means that these companies are going to stay flat. And we started in our new fund, something that I just did yesterday. I finally had like an hour. We were talking about, time and doing the work of the fund, which is operations and finance. And I went through my schedule of investment and I looked at all the markups. And for the last couple of weeks, I've been telling people, hey, we're not investing super early. We're going to invest at that late seed Series A. We're going to skip the flatness of the J curve. And I'm going to come in right at the elbow. And I looked at the markups and I looked at where TVPI is, total value per portfolio investment, and we're already up by like 1.2x, and the fund's not even 9 months old. And I'm like, I proved it out. That's it. We're literally can skip the flatness of the J curve, and that's the power of where both of our funds are coming in. We're not coming in at the pre-seed or friends and family. we're coming in when the business has revenue and it's already popping, because you've got to, I've talked to an LP that was like, I want to come in at pre-seed to friends and family. I'm like, you want to wait 5 to 6 years on the flatness of the J curve, which is death, to finally have something pop by year 6 to 7. And then finally, then another 10 years, I'm like, I'm going to skip all that. And that's the key of where Zach and I find the relationship is come in a little bit later. You're still early, but you can come in a little bit later when it's less risky. The business has revenue, and you now have something to anchor both the investment and the debt. And it's much easier to underwrite when you're not underwriting against something that has no revenue.
Yeah, so a couple key themes you touched on. One is this idea of the J curve, right? And so the J curve, for folks that don't know, is when you make an investment in a fund that does venture capital or other types of investments like private equity, and the fund manager then has to go out and make those investments, and it takes a while to ramp up, and they don't pay off for a while. So you're actually not making money. In fact, you're losing money for oftentimes, anywhere from like 3 to 7 years, depending on the type of fund. And then the expectation is you'll get a big payoff on the back end of the fund. Now, what's nice about your strategy, Adrian, is that you're coming in, trying to get in a Series A where you're going to get paid off quicker than some of these other, seed deals that might take longer. And on the venture debt side, what's great is we don't have a J curve, because as soon as we deploy capital, it's kicking off money from day one. And a lot of people like that because they want to access innovation as an asset class. And so I've actually had a couple of investors in our fund say, hey, the reason I invested is because I love innovation, but I don't have time to wait 10 or 12 years. I have one guy who's like, I might not be alive in 10 years and I want to see something like that. Seriously. He's like, I don't want to like leave my, kids and grandkids with with a bunch of funds that haven't paid off yet. If I can, produce your 15% right off the bat, but also give them that upside, through the equity warrants that we get. So I think that's, something to think about in terms of for folks that want access to innovation, and most people do because that's where the money's being made. Well, how can you do that? And it's not just through one type of VC investment. There's a whole bunch of ways to access it.
Right? Everybody knows how venture capital and venture debt work together is that they're complementary. They work together. It's not like Zach is going to do it by himself. There's usually at a funding round, and the power of it is, and this is where it's worked tremendously in the past. It's, I had a company that tremendously well, it's, the one that's returned 20 to 25x, and they carried a venture debt line for years and they never used it. It was more like a safety net. It was a $1 to $3 million line. It's out there. They're doing tremendously well, 6-9 million in revenue. It's when people think it's operating capital and, I'm going to start drawing from it and then work through it. And because they're at the stage where they're way too early and they're drafting from these lines, that's the danger point. But when you do it where the business has revenue, it's either profitable, it has EBITDA that's rising up, then it's a compliment. Because if you're a business that's making 5-10 million in EBITDA, and there are vendors that require you to have like cash in the bank, right? Use venture debt. You're not using equity. You're not selling equity for something you don't need, and you're just retaining the capital. And that's the power of it when it literally is a complement to an equity financing. Because what people don't understand is that as you go later and later in the J curve, the equity is going to get more expensive. Yes, it's the longer you wait, it's going to be less and less risky. And in our view was, you don't have to wait that long. You can just go to a Series A, a Series B. You're still getting good valuations, but the risk profile goes less and less and less. And now you are able to complement it with, venture debt line where you may bring in, anywhere from $1 to $5 to $10 million. That's capital sitting on the balance sheet. That is now more attractive to an acquirer to say, oh, hey, this thing isn't going to run out of runway. It's making profit. There's a benefit to having that asset with it.
Yeah, I mean, you touched on some key points. One thing that I think is important is that venture debt is for companies that are already doing well. It's never certainly at ARI, and I think almost every other venture lender I know, um, it's not provided to companies that are struggling that can't raise equity. It's actually provided only to companies that have raised equity very effectively, but could use some more growth capital or a little bit of extra liquidity as almost insurance, like you said. And this capital is used for growth, or it's used just for excess liquidity, but it's a lot cheaper than the equity capital. And founders love it because the last thing they want to do when they finally become successful after years and years of sweating away at building a company, the last thing they want to do is sell more equity than they need to, right? Why would you give equity away when you're about to hit it big? And so at that point, debt becomes an option because the company's successful. In our case at ARI, the minimum revenue we're looking at is 10 million per year with a lot of growth expected. And in most cases, the deals we're looking at right now are anywhere from 30 to 100 million in revenue. So these aren't like, two guys on a laptop and a puppy dog in a garage saying, hey, maybe one day we can make a buck.
And that's where I love where you guys are playing, is because you're doing it to support a company that's already profitable. There's no risk involved in it, in the risk profile.
So let's take a half step back and move to some bigger themes on the venture side. I actually meant to ask this before we even got going, but I wanted to ask you what you think are the key themes now and trends that you're seeing broadly when it comes to VC and innovation. So if somebody came to you, a potential investor, and they said, Adrian, what's going on in VC these days? Where are their opportunities? What should I be investing in? What should I be afraid of? Where are their risks? What would you tell them?
Yeah, I think the first one that I talk to people, because, we live, when you look at the life cycle of venture, a lot of traditional LPs did the barbell method, which is, I think I'm going to call the dumbbell method. I'm going to come in super early, and then I'm going to come in super late. Well, on the late side, how's that going for you? Not access to any way out. The super early, you're at the beginning of the J curve. And you and I are both sitting in the middle, where there's just this massive opportunity for companies that are innovating, that are creating revenue. Because here's the thing everyone doesn't understand is the great companies are still raising money. The great funds are still raising money. There's so much innovation continues to happen. This is just a clearing out of the garbage that's out there in the landscape. And I'm a big believer of, great, whatever is happening in the economy, that's actually going in both of our favors, because that middle is where the sweet spot is. That's where the meat on the bone is. And within there, you look at the sectors that are exciting, everything from, where we're playing it. The economies are going down, fraud is exploding. Cybersecurity. We're talking about, deregulation in the last couple of years has led into wacky things like cryptocurrency, which didn't fare well for anyone. But what it left in its wake was decentralized finance. So that's going to be a whole ability where a fintech can start, selling products, changing money, remittances, without ever using any of the PayPal's, Visas, or MasterCards. So we're going to see in the next year and a half this explosion in taking down the incumbents, because there will be no fees in decentralized finance. You can build a company, you can build an app without ever having to pay a single cent, and because you can use the blockchain tokenization usage of doing money. And at the same time, there's a lot of excitement in AI, but this is the second coming of AI. We saw one in, early 2015, 2014. I call this the second hype cycle. And you're seeing AI on everything. And this is the key where, as an LP, if you're going to use a manager, use one that knows the space, that has a history in the space, and that could look through the BS of what's real and not what's real. Because now we look at everything. We're seeing everything has AI. We got everything from, my favorite deck was creating, restaurants and AI. And I'm like, okay. And it was a deck full of pizzas, and the computer vision AI will tell us whether or not there's too much pepperonis or not enough pepperonis. I'm like, who cares? It's a 26-cent pepperoni, if at even that. Like, why are you raising at a $20 million valuation? Who cares? And so after certain slides of pepperoni, you move on and being like, not everything needs AI. And the reality is innovation is going to happen in spaces that are untouched, and finding spaces where with or without AI, they still require innovation. And that's where I think the ability to make money and the ability to generate alpha is putting bets on both companies and managers that can look beyond the hype and look at where like actual revenue is being generated. At Mendoza Ventures, we're a revenue driven shop. You want to prove to me whether or not technology is real? Show me the revenue. You want to tell me whether you have customer traction? Show me the revenue. You want to tell me whether or not you're building innovation? Show me the revenue. Because at the end of the day, if you can't get over that $1 million threshold and you can't of true revenue, you may or may never have anything. Because that's what it comes down to. Can you sell something that people want to buy? How are you going to get to that 10 million of EBITDA that Zach is looking for? Literally, show me the revenue. Because that's the key piece of this, is at the end of the day, it doesn't matter how much you innovate if nobody cares and nobody wants to buy it. Did you actually innovate anything? Because
I'm still laughing about the pizza comment.
oh yeah, that one is the craziest one. When we see everything, because we're still in the early stage of the innovation spectrum, but like the pizza one was like on my deck of wacky decks. Because like,
I should start sending you some that I get. I mean, I probably get 10 decks a week that say they're leveraging AI in some way. And the first question I always ask them is, who on your team has expertise in AI, and what is that expertise? And then it's crickets, right?
And it's cyclical. We see it. We see multiple hype cycles on different things. We see like LPs will talk to us about the market and we're like, no, we sit outside of it. We see trends and they're cyclical. There's a trend and everyone rushes to it. And then the next trend, and then the next trend. And people tell us like, how do you find the winners? And I'm like, the ones that are making money. Very simple as that. Like,
it's a scorecard, right?
Did you not make dollars? And not only that, the key thing, you know, there are people that could do it once. There are people that could hit $1 million once. And then you go to and be like, great, can you do it again? Or is this just a one-off? And that's the key important thing. And that's what it takes to looking at the space and talking to the customers. I mean, heaven forbid we do something that is unheard of in this business. We call the customers. Tell me why you bought it. Tell me what your contract looks like. Tell me how much money it saved you. And at the end of the day, if you don't have that and you can't get a reference, like, you know, this is just market analysis, due diligence 101 is, all right, you sold something. Let's talk to them. Let's see if you could sell it again. And it's just pattern matching. You know, can you take this pattern and do it over again? Can you keep on making more money? Can you actually scale? And if so, what's year over year growth? Because you can stay flat, but the power of VC dollars is not to build a business, it's to grow a business. And that's the distinction that everyone forgets, is it is literally early growth capital. Yeah. Because yes, you can, and a lot of, I think a lot of people now, especially now, they think that VC is, you know, is philanthropy. It's not. It's there to build innovation, because if you're not scaling the business and you're not hiring and you don't have 5-10 families that are growing it and building that wealth out of there, you really have nothing there. Because it's not designed for a science project. It's not designed for like building of tools. It's really designed to like spur the economy in this country.
So you touched on a lot there. I want to take a half step back and just, so summarizing the key trends right now that we're seeing. A couple things you didn't really touch on. I think most people know, but it's worth just reiterating. It's very hard to raise capital as a startup right now. So could you talk a little bit about the funding environment for startups and what that means in terms of opportunities for those that are in the space?
Yeah, it's funny because the first time I raised money in 2008, 2009, where nobody was raising money. What you have to understand is there's $290 billion sitting on the sidelines. In 2008, 2009, there was no money sitting on the sidelines. every asset class had been affected by toxic, mortgages. Every bond, every stock, every portfolio, it was in there. There was no capital. There are funds sitting on the sidelines right now, not deploying in the last 18 months to 2 years because they're just waiting. And at a certain point, that dam has to break. And so when you have that situation of people not deploying, then you have to relook at your situation as a direct investment, as a startup, and look at it and say, like, how am I going to pitch the business? Because I remember when I first pitched my first business, I would go to investors and say, I'm not going to pitch you. I'm going to come back when I have a customer and I have a working product and I show a clear path to revenue. And they were like, oh, I'm shocked. And that's how it should be. And that's the expectation of a founder is, I think the days of pitching when you have an idea and a PowerPoint are dead. I hope they die this time around, but again, it's cyclical. It comes back. It's coming in with a plan and existing customers and showing that you are going to hit your metrics and that you actually have a strategy and VC money is there to help you grow. That's the key of it. I go back to that point so critical of the capital should be there to be, it should be catalytic. It should be there to just start the fire and continue to burn it, not to design a product or think about a product. And that's where a lot of the startups fail because they're not thinking that the capital is there as a tool. They think it's just always going to be there. And when it disappears, that's why we're seeing gaps in the market. But the good founders are still investing. The good founders are still getting investment. The good founders are still building companies with or without the capital.